Welcome, everybody. I am Craig O'Boyle with Assumption Solutions, and I am joined with Randy Zimnock of AssumableSales.com and Rebecca Miller of the VA Assumable Home Loans Facebook group to talk about the VA and FHA mortgage assumptions. So welcome all.
Yeah, good to be.
Hello.
Hello, hello. Rebecca, you want to maybe introduce yourself first? Go ahead.
Sure. So I'm Rebecca Miller, and I am the one who created the VA Assumable Home Loans Facebook group and now co-founder of AssumableSales.com as well. I'm a veteran spouse. My husband was in the Army, and I'm just happy to be here so we can help bring this information to everybody.
Awesome.
Yeah, that's right. Yeah, I'm excited to be here, excited to just bring, education to our community because I know it's necessary, it's needed. Craig is an expert in this topic, and you'll soon realize that as you listen to him and us interact. He's seen a lot of assumption type transaction being processed. So you'll get to hear what his company does in a bit. And myself, my name is Randy Zimnock. I am a realtor. I actually been licensed since 2007. And mainly I partner with Rebecca to help our members in the community. That's the easiest way I can explain it, because there's a lot of need out there for buyers and sellers to work with the right agents to understand assumptions. And that's what I'm here to do. That's what I do in a group. And that's why we also launched AssumableSales.com. So yeah, let's
I love it.
kick it.
All right, I love it. Well, just like you, my background is I'm a realtor as well. I got you a little bit in time. I started when I was pretty much a baby at 19 in 1995. So well, let's jump right in here. So the VA and FHA mortgage assumption process. We'll talk about what is a mortgage loan assumption. We'll talk about why it is why is it valuable? What type of loans are assumable and who qualifies? Then we'll talk about the assumption process that goes from contract to close that we help take you through as a company. We'll talk about our pricing, what we charge. And then we'll talk about some of the upcoming potential changes that we've seen since this process started, some things that are on the horizon maybe or have started to change already. And then we'll kind of go back into strategies and resources that relate to the groups and the webpage that you guys run. Sound good?
Sounds great.
All right. What is a mortgage loan assumption? Well, a mortgage loan assumption occurs when a willing home buyer takes over and becomes responsible for the existing loan of a willing home seller. The two types of assumable mortgages are qualifying assumable and non-qualifying assumable. However, there's really no non-qualifying assumable in existence anymore. That was something that existed really 1989 and before and was phased out to move towards the full qualifying assumable. And almost all assumable loans require that the buyer qualify to the same standard the original buyer was held to during the original loan origination. So the monetary value of a mortgage assumption. So in these kind of four pillars of things we're going to go through, we'll go through different levels of what I think demonstrates the value of an assumption. And the last one will be an example of something that most people don't think about in an assumption. But the first one here is a payment comparison. And it's kind of what I call the headline numbers that get people attracted towards an assumption. So what we'll compare is a $400,000 loan at 7% interest, which equals a monthly mortgage payment of $2,661. And then we'll compare that to a $400,000 loan at 2.75% interest, which gives a monthly payment of $1,633, right? That is a difference in your monthly payment of $1,028 and an annual savings of $12,336. Those headline numbers are very attractive to people. You know, the old saying, buyers, at the end of the day, they live with the payment on the house, not the price of the house, right? This is what they feel on a monthly basis. And so that is a big deal, massive difference. And it's not even the widest range we've seen because while at the time of recording this, rates are probably hovering near 7 right now. I think we got as high as 8%. So it was even more extreme at one point than it is today.
Mhm.
Now let's look at the effect on purchasing power with the difference in rates. This is the affordability crunch that I think we all feel right now. So let's take that lowest payment, that monthly payment of $1,633, which obviously is that $400,000 loan at 2.75% interest. It's comparable to a $245,500 loan at 7% interest, which means you've had a decrease in your purchasing power of over 154,000, 154.5 to keep that same low payment of 1633, right? What that means is effectively your purchasing power is now only 61.4% of the former level. So you've had a massive pullback on what the average buyer can purchase to afford a payment level that they were previously able to get. Big deal there, big deal. Now those two are like I say, I think they're headline numbers. The next column I'm going to talk about here is interest saved over time. This has to do really with the amortization schedule. That's something people see oftentimes maybe when they're applying and then maybe once when they're closing, but they don't think about a ton. I love these numbers personally. So total interest paid on a $400,000 loan over 30 years is $558,000 and change at 7%, or $187,868 at 2.75%, right? That is including on top of obviously the principal that gets paid back over time, right?
Yeah.
You still have to pay the 400, but you tack those on top. That's your interest over 30 years, right? That's a total interest savings if you got that low rate over 30 years of over $370,000 versus if you get that loan at the high rate. That is a humongous amount of money. Let's do an example though of, say, the person who had that home at 2.75% decides to go ahead and sell it and allow it to be assumed, right? And it's 3 years old now. So the interest that person who's going to sell that home has paid in the first 3 years of ownership at 2.75% is just under 32,000, 31,938, right? So that is already paid. The person who buys and assumes that loan does not have to pay it. They have to pay the remaining amount of interest. But when compared to if they got a 7% loan, the amount of savings they will realize is over $400,000, 402,106, versus if they got a 7% loan and kept it for 30 years. So I love this number because the amount of money you save exceeds the original loan amount with the difference in interest rate. It blows my mind. The last column here I'll talk about is an actual example of a deal, but it's not what most people think about. Most people are thinking about, oh, I want to get that lowest rate and that lowest payment. This was different. This was an older loan and it carried a higher interest rate, but I want to show why this might also be something a lot of people should look for and consider. There was a $500,000 loan originated on this house at 5.29% in 2009, and it had a payment of $27.73 per month, right? So over the first 15 years, the loan balance had been paid down to as of 2023, it was $358,759. That's the loan balance that when that seller went to sell the home, they could market because that's what somebody would take over that was left on the loan, right? At the time of marketing the home, the sales price on the home was $900,000. And the assumption gap, which is the difference between that $900,000 and that $358,759, is $541 and change. So took a big down payment. The buyer of this home sold a home in Hawaii, was coming here, so they had that in cash. They had that money, that gap money in cash, right? The interest paid by the seller of that loan over the first 15 years totaled over $336,000. So that is interest that is front-end loaded in an amortization schedule. that was paid out already by the seller of that home. It would no longer be something that needed to be paid by the buyer. Of course, they still have to pay the principal amount that's assumed, but the remaining interest for the next 15 years of payments that would be paid out was only $164,000, right? So not only is the buyer getting a 15-year note until his house is paid off, the true amount of cost to that loan over the next 15 years is dramatically less than what the cost was to the seller of that home who owned it for the first 15 years. So magnificent deal. I love this kind of thing. And to me, it's something that people will probably more and more want to think about because there are loans that were not refinanced or originated between March of 2020 and March of 2022 when rates were effectively below 3.5%. So what types of loans are assumable and who qualifies? Well, almost all qualifying assumable mortgage loans in existence today are either VA or FHA guaranteed loans. Now, a VA loan specifically, it can be assumed by veterans and non-veterans alike. However, only assumptions by another veteran with VA entitlement will release the original borrower's entitlement from the note by substituting the new buyer's entitlement onto the note. So what that means is you're released from liability. You are no longer responsible for that loan. It's not on your credit, anything like that. If a buyer comes to you who's also a veteran and has a matching sufficient amount of entitlement, you guys can do a swap. That will release the seller's entitlement so they can fully use it on buying a new home. Just they're out of the loan completely and go on with their life. If that non-veteran buyer comes, the entitlement will have to that was used will remain with that loan until it's paid off. Now, that doesn't mean that they have zero entitlement to get another VA loan. There's a whole calculation, and that's part of what we check and stuff and looking to do that. But they may have none, or they may only have partial to get that next VA loan. I will qualify and say that about 3 in 10 deals that we're involved with, we do see go veteran to non-veteran. And there's various reasons that I think sellers are willing to walk from their entitlement. In some situations, they may never be buying another house again because maybe they're elderly. We've seen many of those situations. Some situations, we see scenarios where there's 2 spouses that both carry entitlement, and they'll just use the other person's entitlement the next time. We have seen some scenarios where somebody is just getting so much cash, they don't feel like using the VA again is a big deal, or they have enough cash to basically cover deficiencies entitlement. And then in some cases, what we see is people are just like, whatever the heck sells the home. I got to get out. I got to move on with my life. So, but this is something that sellers, buyers, their agents, they need to be talking about this with regards to the deal. I mean, if you're selling a home and you 100% want your entitlement, your agent needs to be marketing it, saying we won't accept a deal that doesn't have full substitution. So those are big things, big topics that people need to be aware of.
And one thing I did notice in our group is some of the members would say that, oh, our agent told us we're not allowed to say that we only want, other veterans or active duty to take over the loan. And that's not true, because
no, you
can't
can't say that.
Discriminating. That's just the terms of your contract, right? That you want. So
yeah, it's not a protected class to require somebody to give you back your entitlement to use again. So yeah.
So go ahead.
Now, FHA loans are assumable and don't carry any type of entitlement issues like a VA loan does. However, they do carry mortgage insurance for the life of the loan. Versus a VA loan, their form of mortgage insurance is basically the funding fee that's collected when the loan transfers, or when the loan is created. They don't do it on a monthly basis like FHA does. VA and FHA loan programs are primarily for owner-occupant purchasers, but I will address this in another section with some changes we've seen in this area. So we'll keep going here. Let's talk about the assumption process. Obviously, the first thing all parties need to do is confirm that the property has an assumable FHA and VA loan. You know, they want to review the existing loan documents. All parties should take note of the loan amount, interest rate, and the payment. Sellers and listing agents, those are numbers you want to market. You want to get out there as many places as you can. You're not violating any rules to talk about the interest rate because this is something that is not changing. It is fixed. It is an asset of the property. It's not based on the buyer's credit, what their interest rate will be for a future loan or anything like that. This is something that's going to be marketed. So,
Yeah,
and
I'm
buyers
glad you
obviously.
said that, Craig. I'm glad you mentioned that because I do get a lot of people saying that their current agent was not aware that they could advertise the interest rate openly. Like they may have something in the description saying it's assumable, but then they don't include the interest rate, or if they include the interest rate, they don't include the principal balance or the payment or the gap. So that's been a challenge because I think there really is some misconception about what they can legally disclose.
Um, Another thing you can do to confirm these things is pull an ownership and encumbrance report, which is what we do in Colorado as a title state. That'll give you the deed of trust. The deed of trust, you're looking for an FHA and a VA case number. If it's FHA, VA, it's assumable. So that should give you that there. And then ultimately, once you've got that information marketed or seen as a buyer, you execute an assumable purchase contract, right? Expect at least 60 to possibly 120 days for servicer assumption approval. The average that we're seeing across the board with all servicers, and this number has come down, is 70 to 90 days. It used to be hard 90 that we were telling people, but it is getting better. But the key here, and the reason it's in bold, is be flexible. People need to be talking to their agents, to the other side of the transaction, to understand everybody's required timeline. If a seller's like, I have to be out of here in 30 days and I need the cash in 30 days from the day we contract, an assumption's probably not the ideal transaction to be in because these servicers, they don't have great systems. They are overwhelmed with files. They don't make money doing it. And truthfully, I think they don't want to do it because if they could loan money out at 7, they make more. But you need to be flexible. There's a lot of words about, how there's requirements with what's supposed to be done from the VA in 45 days. That's always existed. They've reissued guidance that that's the case, but there's loopholes that they're using to get around that timeline. And I don't necessarily think it's because they're doing something nefarious. They're not good at this, if that makes sense. Be flexible. Next, the buyer should have a plan for covering the gap between purchase price and loan amount, which is the effective down payment. $500,000 sale, $400,000 loan, $100,000 down payment.
And that, Craig, is because that overage, that gap cannot be rolled into the assumable loan.
Right. The loan does not change at all. You're not going to be able to do any kind of modification or changes of the loan when you take it out. I've had people even who have said, hey, I have more cash than I need. Can I pay the loan down?
Yeah,
Before you close, you can, if you want to, you can after, and maybe they'll recast, but I wouldn't count on it. So yes, yeah, the loan does not change. Once again, clients should be flexible and understand that this process can take time. Plan accordingly, talk this out. Everybody needs to understand that patience is the key, right? Now, I will, as a side note, I will say, if you're a buyer and this is a great deal, you're saving $1,000 a month, right? And you've got a seller whose patience is an issue. They're worried about the timeline. Maybe pay them more for the house. You make it up pretty quick, right?
Yeah.
If you're a seller, maybe you have one price when you're selling the home if it's a cash or a new loan, and maybe you have another price if it's an assumption. Getting creative a lot of times is like, having a good agent on your team. It's a good reason to come to you guys to connect with an agent wherever you are in the country who is creative, who has resources, who knows what they're doing. So all right. So you've got the contract under. This is kind of where we get involved, right? And we'll plug ourselves. You send the contract to Assumption Solutions, right? Our role is to work with engage both the buyer and the seller and work directly with the servicer to get this transaction to closing, to get everybody to their goal, right? So you send us our contract along with contact details. The first thing we're going to do is we're going to vet your transactions to ensure that it's got a high likelihood of servicer approval. And if you wait for the servicer to effectively do this step, which we can have done within days, you could be waiting for weeks to months, right? Because when you submit things to them, you go into a queue, you go into a line, and you're sort of just waiting for them to get it, right? Our processing team is made up of just like I'm a 30-year realtor, 30-year plus lenders, right? And they've done more of these than anybody in the country. So we're going to vet that. Now, if you're a seller, you don't want your home off the market for weeks or months with a buyer who's not going to be able to get that deal done. And if you're a buyer, I mean, you don't really want to waste your time on a deal that you can't close either. So there's a lot of value, we think, there in the fact that we're going to vet this upfront and get you there. The next step, go ahead.
I want to vouch for you here. And, because this is actually with one of the members from the group, from the Facebook group that Rebecca and I have. And we've connected that member with one of my team members in Southern California, meaning agents on my team. And the buyer was very, very excited. And they went out, I think like that first weekend that we got, connected, and they found the property so quick and with an assumable loan. We put the deal together, right? Negotiated with the seller and everything, agent. And I remember specifically, we submitted the file over to your team, right? Literally the same day, right? Like you say. And the next day, we get an email from your team member like, hey guys, I have some bad news, but it's also good news because we caught it right now, is they don't have enough entitlement left because they own another property and they're short X amount of money for buying this property. And we're like, so this assumption is dead. We're like, wow. Like at first you're like, oh crap. But then you're like, wow, that just saved us, like you just said, months potentially.
Well, and that one might have been on the extreme end too, because that was a kick out, not because of qualification.
No,
the buyer probably did qualify, but it kicked it out because of entitlement. And the funny thing we're finding is the servicers do not check entitlement until almost right before closing, right? So you go, let's say it is a 90-day process and you get clear to close, and then a day or two before you close, the servicer's like, hey, we don't see a sufficient enough entitlement here. And so you've been in this deal 90 days, and now the seller has to go, do I walk from my entitlement and keep this deal? Or do I go back to square one and start marketing this home again?
Yeah, it's a tough situation. So anyway, I just want to, give you a little plug, because honestly, you saved a lot of heartaches for everybody, the seller, the seller's agent, our member from the group, the buyer, and our agent on the team. I mean, everybody wins, regardless of the fact that we had to cancel that transaction. It was actually a win. That's the one time I can say where it's a win that a transaction cancels and doesn't go through.
Well, right. That's what we're here for, right? We're here to keep you out of those deals that you shouldn't stay in. So, but most of these, obviously, they go through. They just take time. So, once we vet the deal, we are assisting in basically what's called the submission of the assumption package to the servicer. That's basically like what the servicer is going to go through to approve the assumption. And the key here is that needs to be done correctly the first time, because when you submit it, if you do it incorrectly, it goes into the queue. And when they finally review it, they're gonna be like, oh, we're missing ABC, or this is wrong or something. They kick it out, and you've then got to resubmit. You're adding time because you're now at the back of the line again. And it's going to take time for them to get to it. And so, if you've got a servicer who's getting these done in, let's say they're on the quick end, which sometimes we see 45 to 60 days, you could turn that 45 to 60 day quick end into 70, 90 or more, just because you're not familiar with what you're doing. Yeah. You don't have a knowledge base in dealing in this world, whereas we're doing it all the time. But ultimately, when we submit this package, it goes in for servicer assumption approval, because they are the decision makers here, right? Now you've had us vet the file, right? We don't see deals that go sideways if we've passed it usually on the vetting stage, unless something catastrophic happens. Somebody loses a job or you know, something wasn't properly disclosed. We have seen that, truthfully. But you know, by and large, once it passes our vetting, it's going to pass their approval, right? But it's going to take time. So what we're doing then after it goes in is we're following up with the servicer on a regular basis to kind of keep positive pressure on them, to keep them moving it forward. Now, we can't force them to get things done. You can't force them to get things done. You're going to move at the pace of their systems. But if you've taken out the mistakes earlier, right, it will go faster. You'll get the fastest that they can go with their systems. And when they issue assumption approval, really from there, you're working towards closing. That's really the last date in any contract other than going to closing. They've issued it. You know, it's got to go through their closing department to issue numbers to the title company and all that kind of stuff. But generally, we're seeing it happen pretty quick once they issue clear to close.
And safe to say, I'm hoping still, because I know when we, you know, speak, you've told this to me, is that, you know, now that you've done hundreds of these, right? And with certain banks, you have a direct contact now that you can talk to, right? Is that still true?
Yeah. We have internal contacts. You know, we even have them at higher levels. Like if we get a situation that is kind of not going the way it should, we have higher level stuff. But at the same time, you know, the last thing I have on this slide is obviously be flexible, because, you know, you have a servicer that's, let's say they are hitting that 45, 60 days consistently. All of a sudden they get 1,000 new files in and they lose 2 staff members, right? People change jobs, you know, they can get backed up. Once again, the key is be flexible. You know, if you talk to us, we can probably tell you what we're seeing as the average for a particular servicer, but we would never guarantee it, right? These things can happen. I mean, one of the servicers who is consistently at 60, we started seeing them get a little backed up, and you know, next thing we know, there was a 70-day deal with them. So it can change, it can flexible, but systems are getting normalized. They're all getting better. I mean, one of the consistently slow ones at 90 days, we recently just closed one in 45 with them, I think it was, you know, and they were consistently at 45. So we're hopeful. We're hopeful that everybody gets there.
I have a strong guess on which one that is.
Yeah, that was Freedom. That was Freedom. Yeah. We're looking for a trend with Freedom. So go Freedom, get better. So, okay. So obviously once you close, you're done with the transaction, but let's talk about what we charge you to get you through. So Assumption Solutions charges each party, buyer and seller, a $750 fee. That's $1,500 per file. The first $50 of those fees, so 50 to the buyer, 50 to the seller, is paid non-refundable at engagement when we start. And the remaining $700 per side only is billed out if you get assumption, approval, and clear to close. We like to think that's very low cost, low risk, high value. So to get you through this, you've paid 50 as a buyer, you've paid 50 as a seller. And then if you get to the point where it's like thumbs up, you can do this deal, you're basically going to pay the remainder of the fee. We think that's very reasonable. I mean, why we've kept it reasonable is 2 reasons. You know, one, I'm a veteran myself. I've worked with veterans as a realtor for 30 years. You know, these people sacrifice, right? So we wanted a deal, offer a service at an attractive price. And then at the same time, our model is based on volume. We do this in all 50 states. We do it all over the country. So we want to do as many as we can. We don't want to gouge any one single participant. We just want to help tons and tons of people over the next however long this is a thing. So outside of our fees, the servicer on a VA loan can charge a 0.5% funding fee to the buyer, unless that buyer has a qualified VA disability where it can be waived. And then there is some processing fees that they can charge. We're generally seeing them come in under 1,000. And so altogether, this is significantly cheaper than the closing costs a person would see usually on a new loan, right? You have your title charges, you got to get your new insurance policy and some regular closing related fees, but when you compare them side by side, it's definitely much cheaper. Okay, let's talk about some of the changes we've seen since we started this company. And I think we'll continue to see changes. So this is something I hope to update frequently. The first one I want to talk about is the possibility of occupancy requirement changes. FHA is for sure still owner occupant only, but some servicers have said about late 2023, they started to say they would allow non-owner occupied buyers to do the assumption. But I will
And that's for
highlight,
VA.
that's for VA. I will highlight it is servicer specific. So the key is it's not universal yet. I think that government entities are going to need to issue guidance as to make things universal, but right now it's at the discretion of the servicer. If a VA, the ones that do allow it though, the kicker in what we're seeing is the entitlement of the seller has to remain tied to that loan. So the seller selling to an investor has to walk away from their entitlement.
Even if it's like a military buyer?
Well,
Yeah.
yes, if they do not live in the home, yes, they do have, if they say, no, I'm buying this as an investment, that
Really?
entitlement, yeah.
I think what it is like when you substitute your VA entitlement, it's kind of like you're tripping the clause where it needs to then be owner occupied.
Got it. That makes sense.
Yeah, I can't say exactly what they're using to do it because like I say, these are obviously internal decisions. These are not guidelines from the Veterans Administration. You know, we've taken on a few deals where we had one recently fall apart where we just didn't know with the servicer. I think it was Huntington. And we're like, well, we'll take it on, but the servicer, just so you know, may not allow this. And turns out they didn't. So that deal fell apart. But then like, you know, Penny Mac, New Res, those two are allowing it, right? So we'll see where that goes in the future, but that can make that the market even more valuable there. So
meaning they allow it, they allow it, but not for the entitlement to transfer.
Nope,
Yeah.
entitlement's got to stay. Yeah. So all right, next thing, possibility of obtaining secondary financing. This is the greatest number of questions I get. Financing the gap. Right now, we have some servicers who started to say, just like number one there, that they would allow the gap to be financed. And so we thought, okay, this is going to get big. And then rumor or fact, I don't know, it started getting out there that the VA wanted to see that secondary financing as assumable. And there just wasn't assumable secondary financing in existence. And so now I'm in touch with a lot of large organizations that are in this space, just like you guys. There are groups out there that are really working hard to try and figure this out. And I think this is the thing that's going to get figured out because they're looking for ways to monetize the opportunities in here, because the average gap we see filled right now is 50,000 plus, right? The biggest one we've seen was $1 million gap on a $2 million sale, right? So that's a big opportunity. Right now, though, as of this recording, we haven't processed a single one where the gap has been financed. Now, people have been creative, like you said, Randy, where they financed HELOC on another property. They borrow money from a 401k. They get a gift from family. You know, I know of some people who maybe they took money from a 401k and they're like, well, after the fact, I'll do a HELOC on the house after I own it and replenish the 401k or something like that. But
because maybe make the point there, because the guidelines don't specify that once you own it and you want to pull a HELOC, then they're not specific about the fact that HELOC needs to be assumable.
Right.
It's only at purchase.
Right.
So
the purchase issue is there. Yeah, the purchase is the issue. Now, if it becomes a thing, you know, the things that will trip it up are, number one, you're going to have a blended rate because the second's probably going to be like 10% plus. So they're going to have to make sure that you qualify on the two payments below your DTI. And then most likely you're only going to be able to total finance on the property's price 90% LTV. So on a $500,000 loan, you're still going to need 50 grand in. And then I will say if they do it, it'll likely trigger an appraisal, which you do not need an appraisal right now. The home can sell with a normal assumption, no financing outside of the loan assumed. You don't need an appraisal. So the home can sell for whatever.
Yeah, because the appraisal has already been done when the original loan was started.
Yeah, exactly right. Exactly right.
So Craig, one thing I do know actually is there is, and you've heard of this probably, right? And Rebecca confirmed this, is there is rumor that the Veterans Administration is working on removing that requirement of the second mortgage to, have to be an assumable loan. We don't know for sure if it's going to happen, but there is rumors that it's in the works. And when that does happen, then the floodgates will open up for more opportunities for you, the buyer. If you're looking to, get secondary financing, you'll have a lot more options because there's plenty of options in the secondary mortgage market that's not assumable. And then you as a seller will have a lot more buyers wanting your property, which is a good thing for both parties. So
yeah. When this does get figured out, which like you said, I think the entities are going to have to put, pen to paper and create written guidelines for this. But when it does, it's just going to make this, it's already a hyper market. It's going to make it doubly as hyper. I mean, it's just going to go nuts. So that's a big thing that will come. So.
And then I just wanted to add that, in the past, people have been able to get these secondary financing here and there. I've seen some people comment in the group about, successfully closing with secondary financing. And it's kind of like, a dime a dozen situation. But I want to say that was sort of before some of these lenders and servicers were paying attention to that assumable second being stated by the VA, so there were some credit unions here and there, and maybe one other larger lender that we were aware of when we started the group and, started to get familiar with these options that were supposedly doing it. And some people did successfully close on it. But we've seen that shift now where more of these loan servicers are paying closer attention to the VA guidelines, because we've also drawn attention, right? When we call and we point out, hey, you're taking too long, you have to, pay attention to this or that. So they have started paying closer attention to what the VA is saying. And while the VA is saying the second needs to be assumable, we've seen more of these loan servicers now come out and say, no, we're not going to accept any secondary financing unless it's assumable. And as you stated, Craig, currently there is nothing like that on the market that we have found.
Yeah, but this will change. Somebody will figure it out. There's too much money to be made, in my opinion.
Yeah. Now, last thing though, correct, on FHA, that's not a requirement you've seen from servicers, correct? FHA is
we haven't seen any seconds on FHAs either. Yeah, so I think FHA honestly is going to follow whatever lead is put out there by the VA. Truthfully, we're seeing far more of these done VA than we are FHA. We're trying to get that up because it's a good deal is a good deal. But I think, not having that mortgage insurance makes that VA loan more attractive.
True. I do believe we have a deal in the works that is an FHA, correct, Randy, that somebody went through, or they just started the FHA assumption process because maybe they weren't able to find a VA assumable in their market, but even with the mortgage insurance and that lower interest rate, it still ended up being a cost savings that was worth pursuing.
Oh yeah, you're still going to save money for sure. But we're seeing, for every 5 deals we do, we get 1 FHA. So
okay.
Buyer pre-verification. So this is something we've added in based on market demand. So, obviously we get involved when you have a contract, right? But we have had a lot of people say, hey, I want to find an assumable, but what is my range? You go to get a new loan, you get a pre-qualification. We don't use that terminology because we don't offer any financing. So what we have started doing is the piece that we do in vetting a buyer, we will do before you find a property.
Love
That
it.
does mean we
I
charge
do
the
love this.
$50 fee, right? But we'll be able to give you kind of, this is the range of a deal that you should be able to get approved by a servicer, right? And then we do not charge that $50 fee again when you find a property, right? You've already paid it once, you know, now the only remainder is once you find that property and it gets approved, we'll bill out the 700 fee. But yeah, that's kind of our process there to get people more into the marketplace, I think, so that they feel like
More
this is
confident.
what, yeah, more confident. This is what I wish, what I should look for. Might even help them in their negotiations. Say, I've already talked to these guys.
Oh
They've
yeah,
already done
that's
this.
true.
So yeah, so we've added that in recently in about the last month. And we haven't pushed it hard yet, but we've already done quite a few of them. So
Well,
And
that's a
Craig, this could help on the, sorry, this could help on the selling end too, right? For sellers, because if they are in connection with you and they go to market the property as assumable, they could tell their agent too, like, hey, I want the buyer to come pre-verified.
yeah, it could be beneficial to the seller for sure. Just so that they don't miss any market time with a buyer who's not going to be able to get through our vetting stages in the transaction. But we do that so quick, you're not going to lose a lot of market time anyway, as long as people are quick in getting us our requirements and what we need to vet them. So, but we're excited about it.
Yeah, I love this that you added this, you know, because like that should be like, I agree with what you said, Rebecca. Like we should make this a standard, you know. Um, this can save again headaches. It's all about
That's
Yeah,
the goal. That's the
knowing
goal.
it, because one thing you got to know, which I'm sure if you know our community members, they're military mostly. I know we do have some civilians in the group, but you know, the entitlements change too based on counties too. So it's like if you're owning property and it might get confusing,
It's
right?
very confusing.
For
Yeah,
you
that's
to
why
figure
we
that out.
exist. Yeah.
So I would rather have someone like Craig tell me like, hey, where am I at? If I sell here or keep this property and buy here, what's my buying power using this entitlement, right?
yeah.
So,
And you know, as at Assumable Sales, we work closely with Craig. So if you do use one of our agents, this is going to be something that we are seeking to do, is to get you pre-verified.
Absolutely. We're here for it. So, let's see. Handling of escrow accounts, I'll just say it's the Wild West. You know, what you might expect you would get refunded as a seller or what you might expect you'd have to bring as a buyer, that can fluctuate from servicer to servicer. Whatever they say is ultimately going to be the rule. We're not talking massive differences in money, but you know, I mean, depending on the time of year, when the taxes were last paid, when the insurance was last paid, sometimes there's deficits in an account. You know, sometimes the new insurance policy the buyer is going to get is higher. That can change the payment. So just be aware that this is a little bit non-standard right now, but I wouldn't overthink it at the same time. The last piece I want to talk about that's big, VA eligibility restoration. What this refers to is when a swap is done, right? A buyer brings their eligibility and the eligibility of the seller is released. Well, the timeline on this is not like getting a new loan. In a new loan, you can sell your home and you can walk out of that room and into another room and close and get an immediate new VA loan. Well, in an assumption, the entitlement, the servicing lender has 45 days to notify VA that the entitlement has been swapped, and VA has another 30 days to reinstate it for that seller to become a buyer. So that's potentially 75 days before you can go from selling your home to buying with a new VA loan on an entitlement swap. This needs to get better. I'm hopeful that it will. But right now, people need to make plans if they've got to buy after. I mean, if they have to do it immediately, that might actually kill an assumption deal if you've got to do it immediately. But
Now,
you
Craig,
know,
this won't matter if that person still has enough entitlement left in the market they plan on purchasing.
correct. Yes, if they have enough entitlement left and they can bring cash and cover, you know, what they need to do, they're okay. But this is talking about if they need their full entitlement
Yeah,
to do that in the swap. So
gotcha.
it's a
And it,
complication for sellers, and another reason to maybe try to get a premium to sell your house or pay more if you're a buyer, because you're getting a big benefit as a buyer of these, right?
yeah.
Make it worth the seller's time.
And I know I do know that a lot of members in our group are not aware of this issue, right?
Mhm.
And but we also speak to a lot of members that are doing both, selling and buying, and they want to sell their property with an assumable loan, and they want to buy with an assumable loan in a different state. So we will connect you to the right agents in both. However, you need to also be aware of this challenge. So the way I would approach it would think about, and learn the market in both. What is the market doing? Don't assume that if it's a buyer's market in where you are selling, don't assume automatically that it's also a buyer's market where you're looking to buy,
That's
right?
true.
Speak to an agent there as well. And if it's someone you find, or if it's someone we connect you to, but learn about what is going on there, because that might impact your decision making on what you're going to do on the sell side, right? Because knowing there's this delay, right? You might make a decision to, you know what, I'm going to sell my house and not through the assumption process, right? Because I want to be able to move right away and buy over there with no delays.
I did want to speak a little bit with my real estate agent hat and talk a little bit about actually marketing the properties. The key is getting the information about your assumable loan out as many places as you can. The first basic place to start, assuming you have an agent, is the MLS system, right? MLS, where agents put property. There's usually places where you can put information about the loan type, the balance, the interest rate, and the payment. And you want all of that in there, like we talked about before. The next places that get to the public are syndicators, things like Realtor.com, Zillow, all that stuff. Anywhere you can get this information into public remarks, you want to put it. People are hunting for it. Show them the asset, right? Then obviously leverage social media to market what you've got. Your group is used like crazy for this, and I think it's a great thing. Get into this group and get your house that you've got. Make sure you don't leave anything out though. Balance, interest rate, payment. That's what people need to know. So make sure that stuff gets in there. Obviously anything else you're doing to market, like flyers, open houses, sign writers, the more you can show contrast between the asset you have and the greater the contrast, the more valuable what you are selling is, right? Going back to those numbers, I mean, the lowest rate we've seen processed was 1.75%. The last thing I'll just say in this slide is, we like to think we're a team member for you. So don't be afraid to say, hey, most agents and buyers don't know how to get to this, but I have a team at Assumption Solutions that can help you get to the finish line. So that's all I'll say there. So last, let's talk about just some of the resources. This is primarily where I'm going to let you guys take over, kind of chiming in with the benefits and what your goals are and how you create it and just everything about both VA Assumable Home Loans Facebook group and Assumable Sales. So take it away.
Start, please.
Yeah, so last year, beginning of the year, my husband and I were looking into options to, possibly upgrade our home or relocate to a better area. And, interest rates were very high. And, like it's been touched on in this presentation, our purchasing power was significantly impacted. So looking at the area that we wanted to move, it would have been very difficult to qualify for that because of the high interest rates. So I started looking into a lot of these bigger VA groups, regular VA loan home groups and VA help groups. And nobody was really talking about it at that time. Like here and there, people would have questions, and I even tried posting questions. And very often I would either get shot down right away, or a lot of negative responses and some misconceptions about the entire thing. So I started doing my own research and educating myself and realized like there were a lot of benefits, a lot of opportunity with assumable loans. And so, I was like driving around one day, last, summer, and I was like, oh, I'm just so frustrated with this whole thing. And I was like, if I can't find the group or the people that are going to help me, I'm just going to start it myself. So I did. I started the group just to kind of get the word out there. And I had no idea like how quickly it would take off. Within a couple months, I was already, I think, like about 1,000 people in the group, maybe a little more. And there was like a real hunger there, like what I had, to find more information that was not yet widely available, and to have open, free discussions about it, and then to let people even start sharing their listings. So it just continued to grow from there. And then I realized, like, okay, I would have a lot of people reaching out to me too, like, how do I get help to find properties? Do you have an agent that you would recommend? And this, that, and the other. And I was like, okay, as we're growing, I think it's time for me to start looking at the professionals I can bring in now to the group who are going to be assumption friendly. Because before then, it was really hard to find people who knew enough about it, or, were even open to pursuing it.
Yeah, I love this. So I mean, yeah, I'd say it's a God thing. We were put together. There's a reason for it. And it's cool that we get to help so many people. But I literally, when I connected with you, Rebecca, I remember telling you, it was like, no, I was literally looking at this niche in the fourth quarter of 2023 when the market really slowed down. I've noticed that more assumable listings were popping up on the MLS. And I was like, this is going to be really, really, really attractive. Like a lot of buyers are going to want to take advantage of it. Why would you consider, potentially hiring an agent on the sales side? As this is guaranteed, you'll get more exposure listing it on the MLS. So that's a given, right? But another thing is just getting the marketing message out correctly about your asset, right? The way we're describing it here. Right. So that's number one. And then, of course, working hand in hand with a company like Craig's company to get the process done to the end. Ultimately, we want you to become a homeowner if you're a buyer. If you're a seller, we want you to sell your house, right? With an assumable or without, right?
Oh yeah, I was just gonna say, we do have people that come to us from time to time that will say, like, I want to sell through assumption, but I'm not going to put it on the MLS. So there could even be some properties that we know of from the group, in the area you're looking in.
Yeah.
And you may not find it on the MLS because it's still getting ready for the MLS, or the person just isn't interested in advertising it publicly. That does happen too.
Yep. Well, you guys have built something great. I'm proud to be part of it.
And Rebecca, I don't know if you know this, but since I kind of do most of the connecting with between the members and the agents, we crossed over 250 members. We've connected with agents across the country already. So
wow, that's fantastic.
Proud to say that we're making a difference. We're helping people. I don't know how many of those will end up buying, of course, right? That takes time to transpire, but it's cool to know that it's working. Your vision that you had a year ago, it's happening. So
I'm excited to see where it goes.
Well, the market's got a lot of legs left in it. So our last site here, obviously, here's our contact info. You can get us through the Facebook group too. I'm the guy that probably will call you back if you leave us a message or shoot us an email. So yeah, I'm excited. I think you guys got a great project, and we'll keep moving this thing forward.
Awesome. Yes.
Okay.
Good stuff. Thank you, Craig.
Thanks, guys. Have a great day.
Thank you.